right, and welcome to this mini-series, Idea to IPO in 12 months, and why entrepreneurs should consider going public. Now, this could be a big decision for a lot of people, because I think most people have a lot of misconceptions around around the kind of idea of taking your company public. I think a lot of people like this idea of, ringing the bell and creating all this additional shareholder value through a go public transaction. But I think they have ideas that maybe this is something they do at the end of their entrepreneurial journey, or that they do it as a big capital raising exercise or something like that. And so I want to try and dispel some of the myths, try and get people to understand the advantages and disadvantages, and kind of what's involved, the nitty-gritty of what you have to go through to do stuff. Now, what's really interesting is you don't necessarily have to have a company to take advantage of this strategy. So, I mean, obviously, if you have a company right now, you could take that public, and then you could use that public company as a vehicle to go and do more M&A transactions, so buy up more competitors, consolidate your marketplace, or simply use it to attract better talent and win bigger contracts. But if you don't have a company at the moment, then you could identify a company that would like to go and execute this strategy. And this can be quite a financially rewarding process to go through. Effectively, you can end up taking a stake in the IPO for effectively, putting a deal together, or potentially putting a roll-up together. Now, obviously, through my Harbour Club community, we talk a lot about identifying companies that aren't for sale and looking for opportunities to work with them that are mutually beneficial, so they get benefit out of it and so do you. And you might say, well, if they know how to do this, why wouldn't they go and do it themselves? Well, there's a few really good reasons. The first one is most people are pretty busy in their businesses, and going public, taking a company public, is almost a full-time job in its own right. So it's very hard to run a company and run an IPO at the same time. So working with somebody to do that can be quite appealing for the business owner. The second thing is it's kind of nice, the first time you jump out of an aeroplane, to be strapped to somebody that's done it before. So by partnering up with someone like myself or my team, you can effectively leverage that experience to take them through the process. And the other factor is it's incredibly expensive. So if they do it themselves, they're probably going to appoint a corporate finance company or an investment bank who they will immediately have to start paying retainers to. And this can get pretty out of hand. In fact, most IPOs don't go ahead. The majority of IPOs that are started don't go ahead. And I genuinely believe that's because the advisors effectively bleed the company dry, and they simply can't afford to carry on with the process. It gets to the point where the juice is no longer worth the squeeze. So they'll quite often tell you it's going to cost you 300 or 400 grand and it's going to take 6 months. And after you're 18 months in and 700 grand in the hole, people tend to sort of lose the will to live and to give up. In fact, when I listed my first company, I put on Twitter, it just goes to show with unlimited time, money and resources, you really can achieve anything. Of course, that's a joke, but I was kind of pointing to the fact that I can't believe a normal person could actually get through the other side of this process. I had approached it from being, from the position of being an independently wealthy person that wasn't running a business full time. And so I was able to throw the time, the money and the resources at just getting the job done. And I genuinely think if you're running a business and you're running a budget in a business, you don't always have that luxury. What was really funny is the second IPO I did a few years later, my team, by the way, gave me a mug with that slogan on it. There was a mug that said, it just goes to show with unlimited time, money and resources, you really can achieve anything. And it just happened that I was moving house around about the time we did our second IPO. So it would have been the end of 2018 when we did the second IPO. And that was also a pretty painful, drawn out process that we went through. And as I was moving house, literally about a week before we went public, and you're at your wit's end, because it feels like it's been 2 weeks away for about 6 months, so you're a couple of weeks away, a couple of weeks away, a couple of weeks away, and 6 months later, you're still a couple of weeks away. And I'd moved house and I unpacked this mug literally a week before, and it was kind of like, oh yeah, I remember this now. This is a challenge. But anyway, suffice to say, with a bit more experience and a bit more understanding, I now know how to shortcut a lot of those issues and a lot of the things that I wouldn't do now that I'd done in the past. So yeah, you can piggyback from my mistakes and hopefully move forward in a much better way. So if you have a company, great. We can talk about that. You'd be surprised. You don't need to be as big as you think you do in order to go public. If you don't have a company, you can go and look for one. We actually have a 21-day email course that you can do. It's completely free, just to really see if this is the kind of thing that's for you or not for you. There's a link below here where you can get access to that 21-day email course anytime you like. Basically, you'll get an email every day for the next 21 days. It will tell you how to source and identify potential targets. It will tell you what to do when you found one. It will tell you some deal structures you can use if you want to take equity or acquire one of those companies without using any cash or borrowing money from banks. It will tell you some turnaround tactics that you can implement in order to immediately increase the shareholder value in the company. It will go through some exit techniques, so things you can use to sell the business if you're not going through this IPO process. And there's also some wealth management ideas that we threw in there as well, which is basically how rich people protect their wealth and create fantastic incomes from their wealth without going into crazy, risky sort of strategies. So you might find that useful. Please feel free to dive into that. The first thing I think we should actually cover is what is an IPO, because I think people think they know maybe what it means, but just to be absolutely clear, an IPO literally stands for an initial public offering, and what that means is it's the first time your shares have been made available to the public through a stock exchange, so available for people to buy through a stock exchange. Now, there are other ways to go public other than an IPO. An IPO is the traditional way of going out and raising money at the point that you're listing, and then listing on a either unregulated or regulated stock exchange, and we'll come on to the differences between those later. You can also do something called a direct listing, which is technically not an IPO, and you can also do a reverse merger or reverse takeover, which is where you find an existing public company that you reverse your business into as a way of going public. Now, there's lots of different nuances around these strategies, and there are also lots of differences between which jurisdiction, which exchange you list on, and all of those sort of things. So we will dive a little bit more into that. But basically, an IPO is taking your company public and offering your shares to the public for the first time. So some of the common myths: I think people think you have to be absolutely enormous to go public. In fact, there are exchanges, they're normally called MTFs or multilateral trading platforms or junior markets. There are markets around the world that actually cater for startups. And so it is possible to list a business, even a business that's pre-revenue, and certainly businesses that are pre-profit. I wouldn't necessarily recommend that. I think you have to have a bit more of a proven business model in order to make it a really compelling story to investors. And also remember, there are extra costs associated with being a public company that you don't incur when you're a private company. So it's not a bad idea to be able to afford to bear those costs. So I tend to say that until you're generating about 500,000 pounds, euros, or US dollars, it doesn't really make a lot of difference. Until you're generating about 500 grand's worth of free cash per year, I probably wouldn't look at doing an IPO, because you're going to have about 100 grand a year's worth of additional costs associated with being a public company versus being a private company. If you want to do it right, you can cut corners and get that cost down, but if you want to do it right, that's the sort of bare minimum. And so obviously on a 500 grand of free cash, you can afford to do that and still sort of stack up. But if you're much less than that, it starts to be an unwieldy percentage of your overall profitability. So, to make sure that this is sort of comfortable, I would normally look at around about £500,000 of profit. Now, obviously, £500,000 worth of profit can be generated from a relatively small company. So, a lot of small businesses tend to engineer their accounts in the most tax efficient way possible. And so what they do is they recognize revenue as late as possible. They recognize costs as early as possible. These are called accounting treatments. When you're going public, you would be advised to adjust those accounting treatments to optimize your profit instead of optimizing your tax position. So you might find that a company that was doing 2 million in revenue and a couple of $100,000 of profit might actually be doing about 500 grand's worth of profit when you rearrange the income and cost recognition. So you might find that you don't need to be that big in order to meet that minimum. So size is a bit of a red herring. You can be smaller than I think most people think, or you can identify a company that is smaller than most people think. The next part is cost. Now, there are very high cost jurisdictions to list a company, and I think it was Morgan Stanley that published a report saying the average IPO cost $2 million, and I can absolutely see how that would work. And my second IPO did indeed cost about $2 million, but that was because we went for a very high cost jurisdiction. We used a UK PLC, and we had our prospectus approved by the UK LA, so we went for a fully regulated listing, and we went for one of the most expensive jurisdictions in the world. Basically, if you're in the US, the UK, Singapore or Australia, and Hong Kong, but not so many people list in Hong Kong anymore because it tends to be a bit China centric. So if you have a good China story, Hong Kong can work. It used to be more of an international market, but it's become a lot more parochial in recent years. So if it's Australia, Singapore, UK or US, you'll generally find there are very heavy compliance costs, because just simply the legal fees and the advisory fees are just much higher in those jurisdictions than they are in other countries. In other words, in the US, the lawyer might charge you 100 grand to do something that would cost maybe 20 grand in the UK, but cost 3 grand in Europe. So, I mean, it's literally that kind of order of magnitude of difference. So obviously using advisors in lower cost jurisdictions can have a massive impact on the overall cost of listing. If you distill it down to simply the exchange fees are often related to the market capitalization of the company, so the size of the business. So if you're listing a small company, those fees are actually very small. Where we're listed with one of my companies in Frankfurt, it's about €2,000 a year for the actual exchange fees. So it's almost nothing. The sponsor fees are less than 10,000 per year. So it doesn't need to cost a lot. By the way, if we'd done a similar thing in, say, AIM in the UK, the fees would be between £300,000 and £400,000 a year for the same thing, because of the way that the sponsors work in the UK and the way that they charge for their services. So cost can be dictated to a high degree around where you choose to list. The other big misconception is that you IPO to raise money. Now, of course, you can and quite often do raise money when you do an IPO. What tends to happen is that you raise money at a relatively low valuation in order to make it appealing for investors. They want to see that there's upside for them after listing, which is quite often why you see companies go public and then have this pop in valuation after they've listed. It's because the investment bank wants the investors to get a good deal, and so deliberately sort of underprices it. So there's not necessarily a big incentive to raise a lot of money at the point of listing. You're almost better off raising a little bit at the point of listing and then coming back for more once you've had some experience on the market and you've proven your model a little bit. The other aspect is that if you're raising lots of money, there's a lot more work to do. So for example, if you're raising less than $1 million now, you don't even need to issue a prospectus on a lot of exchanges. Now, a prospectus is the most expensive, time-consuming part of doing a listing, because the prospectus has to be approved by a regulator. So there's a lot of toing and froing of between the document and the regulator. And the entire document is submitted and edited by a securities law firm. And you will also probably have a reporting accountant or auditor that's heavily involved in the production of the document as well. So you're really giving them a blank check at the beginning of this process when you start to do a prospectus. You're giving them a blank check to keep playing ping pong with the regulator on the wording and presentation of that document. So that can run into the hundreds of thousands of pounds or dollars, and can also add a huge amount of time to the process. I mean, I've seen prospectuses take over a year to go through the approval process, and that can even be on relatively simple sort of business propositions. Of course, they can be done quicker, and often are, but you kind of just have to feel it out as you go, which is you're completely out of control in that process. So you don't have to raise money, and I would always advise either not to raise money or to raise as little money as possible. So sometimes you have to raise money in order to comply with the rules of the exchange that you're listing on, because they will have a certain liquidity requirement, an amount of shares that has to be in the public hands, and a minimum number of shareholders. Now, there are ways that you can meet those requirements without doing a public offering, but it's worth bearing in mind that you might have to raise a little bit of money just to comply with those regulations. The other thing is, I think people think that an IPO is an exit. Oh, I'm going to take my business to 50 million and then I'm going to IPO. Like that's the end. If you're in the management of the company, the IPO is the beginning. You know, that whole slog to actually get listed is really the slog to the start line, and everything else kind of starts after that. It's after that you have the fun and the growth and all of that stuff. And I think this misconception comes about because there are quite a few venture capital and private equity companies who stay in a business up until the point of IPO, and they use the IPO as their opportunity to take their sort of chips off the table, and then they go back and do it again and again and again, and that's their kind of model. However, that's not how it works for the entrepreneur. When you go public, the shareholders you're asking to invest in your company will be expecting you to be buying into your own business vision. It's very hard for you to run around telling people that you think this is the most awesome business you've ever seen, but at the same time you'd like to sell all your shares at the current price. Those two stories don't match up. And on most exchanges, the management team will be locked up for at least 12 months after the listing date to show their commitment to other investors. And of course, if you can lock up more or put other restrictions around the sale of the stock, that will also help when it comes to raising money. It's a better story when you're doing your roadshow and trying to convince people that they should write you a check, if you're very much vested in the future outcome of the business. So you should definitely not treat it as an exit, but treat it as a platform to grow. You're doing the IPO in order to give you this platform to really grow the business. One of the most common mistakes that I see is people who just list where they live. And I know how you fall into this trap because I've kind of done it myself, which is that you're thinking, okay, I'd like to IPO my company. Now, I grew up in the UK. My first businesses were in the UK. So when I had a thought of listing a company, my first thought was the London Stock Exchange or the AIM, which is the junior market in the UK. And so I reached out to UK advisors. Now, I don't know if anyone's ever done a listing or offering in London, but it's basically like a bunch of old public schoolboys that all control that whole industry, and it's very much a closed shop. They all speak to each other, they all know what each other are doing, and they are basically a cartel when it comes to the fees that they charge people. So, you will end up paying 10 times as much, for example, to list in London as you would in almost any other European exchange. And it used to be an advantage to list in London. London is a large capital market. There's good access to capital there. But that advantage has been ebbing away for a number of years. In fact, most of the value in the City of London is kind of FX trading, derivatives, the bond market, the metals exchange, the reinsurance market. It's not necessarily stock exchanges and share trading. In fact, Amsterdam does more share trading than London. So So yeah, there's not really a massive advantage in just listing where you live. The problem is when you reach out to an advisor nearby, if you're in Sydney in Australia, the advisor that you reach out to will be an advisor for the ASX, the Australian Stock Exchange. So they will recommend that you list on the ASX. If you reach out to an advisor in London, they will recommend you list in London on whichever exchange they happen to be affiliated to. If you reach out to, a New York broker, they're going to recommend the only markets that you go on be the New York markets. So it's very hard to get independent, sensible advice around where you should list. And actually, this can be quite a large destroyer of shareholder value. There was an analogy I used to give years ago, which was, if you're in Hong Kong and you're in the Mandarin Oriental Hotel and you draw the curtains, you see two office buildings in front of you. One of them is Bank of China and one of them is HSBC. Now, both of those are very similar banks in terms of the type of business that they engage in. HSBC does all the same products and services that Bank of China offers. They're both global banks. Very similar business models. HSBC, although HSBC does seem to get in all sorts of trouble for criminal things like money laundering and all sorts of stuff like that, whereas as far as I can see, Bank of China has managed to keep its nose fairly clean. But HSBC is listed in London and Bank of China is listed in Hong Kong. HSBC consistently gets a multiple of earnings much, much higher than Bank of China. Now, when I first looked at this, and I haven't looked for a while, HSBC was trading at about a 12 times multiple. I'm sure it's not now, but back then it was trading at about a 12 times multiple, and Bank of China was trading at about a 7 times multiple. So that difference in value was worth billions and billions and billions of dollars. And basically, the difference was that Bank of China chose to list where they live. They went for the most convenient location based on language, culture, and probably the advice that they were given at the time. Whereas HSBC went for a large capital market where they would get the best valuation. So it's a smart idea to look at all the different listing venues that could work for you, and try and understand where you're going to get the best valuation, where you're going to get the best liquidity, and which exchange works for your kind of size, shape, and business model, which can be very important. So why, if they're the negatives, if you like, why would you list? What are the reasons to list? Well, the first one is the credibility that being a listed company gives you. So, when you're pitching for new clients or tendering for, a big contract, being a fully reporting public company has a lot of advantages. It's, you have a lot of disclosures, you're very transparent. There's definitely a perception that you're going to be around for longer. And so it really helps you punch above your weight when it comes to, pitching for new clients and stuff like that. So attracting clients is one part. Attracting talent is another part. If you want the best people in the industry to come and work for you, positioning yourself as a public company is a great way to attract people. It also gives you more things you can incentivize them with. So, if you're a small private company and you give a key employee some shares in the company, really those shares are worthless to them because there's not a ready market or ready way that they can value those shares or sell those shares. Whereas when you're a public company, they can literally look at their Yahoo Finance app on their phone and they can see how much those shares are worth. So it's a fantastic way of attracting, the most talented people in your industry to come and work for you versus working for that competitor down the road. Now, the bit that I really like, I'm an M&A person, so of course anything to do with mergers, acquisitions, or exits is always very exciting to me. But as a public company, it's much easier to go and do mergers and acquisitions. For one part, you're more credible. So when you're approaching target companies, you've got this credibility of being a public company, which is very, very helpful in opening the door and getting a conversation with them. But the second part is you have a currency. And this currency is your public traded stock. So you have shares that you can create more of that have a demonstrable value. That value is tested every day on the market because people are buying and selling shares in your company. So it's a very demonstrable value. It's a value you can prove. And you can effectively issue new shares and use those shares to acquire a target company. So effectively, they then join your business, they get public shares and you get their private shares, and they then become part of the overall public company. So it's very easy to do a roll-up or consolidation of a sector using those shares as the currency for acquisition. And the great thing is that public companies are normally valued at a much higher level than private companies. So you get an arbitrage where you give them, less value in shares than you're valued at. So just to keep it really simple, if you're valued at 10 times earnings and you're making $1 million a year, that means you're worth 10 million. You might be able to buy another $1 million of earnings for 3 million, for 3 times earnings. So effectively you give them 3 million of shares, but you double your earnings and therefore potentially double the value of the whole business. So effectively for 3 million of shares issued, you could grow the business from 10 million to 20 million of market capitalization. So, so it's a really appealing sort of arbitrage or structure that you can use for growing the business by acquisition. There are also other instruments. At the end of this presentation, I'm going to take you through a new financial innovation that we created called an extra bond, which is another currency that you can create effectively for buying companies. And the great thing I love about creating these currencies, whether it be the public listed shares or the extra bonds, is that it means you're not using cash and you're not borrowing money from banks when it comes to doing acquisitions. Because if you're using lots of cash, obviously that's a drain on your cash resources, and if you're borrowing money from banks, that creates an awful lot of risk, because as Warren Buffett famously said, there's only 3 ways for a rich man to go broke, and that's liquor, ladies, or leverage. And he said, and actually I only say liquor and ladies because it begins with an L. It's really leverage. So it is borrowing money that tips people over the edge. So anyone that's watched any of my stuff will know I don't like leverage buyouts. I don't do leverage buyouts. And this is a great antidote to the leverage buyout. The other advantage, the final reason why you would list, is valuation. Public companies are valued at a much higher multiple of earnings, or just generally a much higher valuation than private companies. And part of that valuation comes from the liquidity that public companies benefit from. Liquidity means that when an investor invests, they can divest very quickly. So an investor can invest in a public company in the morning, and it can sell the shares again in the afternoon if they want to. Maybe there's some bad news comes out, or some good news comes out, or whatever it is, they can divest. If you're invested in a private company, you're really a passenger in that business until the owner decides to sell or go public or do something, and that could take decades. In fact, it could never happen. So in a private company, you really are a passenger as a shareholder. In a public company, you have this liquidity, which really gives you a big advantage. So valuation is another key aspect. Public companies are valued at a much higher level than their private equivalents. So let's come on to exchange selection. I'll move myself over to this side. So there are 2 types of exchange, basically. There's regulated and unregulated. So regulated means that the financial regulator of the country you're listing in is responsible for you as an issuer. When you sell shares, you're called an issuer. The regulator in that country. So if you're a UK PLC, you're going to be regulated by the FCA. It's actually a division of the FCA, the Financial Conduct Authority, called the UKLA, the UK Listings Authority. If you were in Germany, it's called BaFin, B-A-F-I-N. If you're in Singapore, it'd be the Singapore Monetary Authority. If you're in Australia, it would be ASIC. It depends where you are in the world. You get that regulator regulating you. If you're on an unregulated exchange, then generally you're regulated by the exchange itself, although what they do in a lot of cases, instead of the exchange doing it, they subordinate that activity to a sponsor, or a corporate advisor, or a nominated advisor, whatever. They're the same thing basically, but it tends to be an external firm, either a corporate finance firm, accounting firm, or sort of stockbroking firm, that would basically conduct the due diligence and compliance tests on the company to make sure that they meet the standards of the exchange. And then effectively they sponsor you with the exchange. So they take you to the exchange and they vouch for you. So, so on an unregulated exchange, obviously you have the sponsor relationship that you have to work with, and on a regulated one, you're dealing directly with a financial regulator. Now, there are kind of positives and negatives associated with both of those. The advantages with the regulated stock exchanges, it tends to be kind of tick box driven. So there tends to be an admission criteria, and as long as you meet that, it's very unlikely that you won't become listed. With an unregulated exchange, you sometimes find that the advisors or the sponsors can massively overreach their remit because they see it as an opportunity to charge you lots of fees. So you'll see this particularly with the AIM nomads. So a nomad is a nominated advisor for the AIM market in London. They routinely overreach, charge way too many fees, and of course you can tick all of the boxes and they can still say no. So you can invest huge amounts of money and not actually get your company listed at the end of it. So so unregulated markets in other countries can be quite good options if you have a pragmatic sponsor that you know, is open and honest with you and is not going to charge you crazy fees to get through. So which country and what are the considerations? Well, actually, business model has quite a bit to do with this. So one of the things I see the main advantage of going public is this consolidation to acquire lots of additional businesses. In different countries or different exchanges, they have different rules around what you can and can't do with acquisitions. So, for example, if you have one company and then you buy another company that's in a different type of business, you may have to recomply with the exchange, which basically means it's kind of like going public again. Or if you do a really big acquisition, you might have to recomply with the exchange. So, for example, on the London Stock Exchange, the main market, if you issue more than 20% of your market cap in a 12-month period for an acquisition, you have to recomply. So obviously with the company that we listed, I think we would have had to have recomplied about 4 times in the last 2 years. So so that was why we didn't choose the London Stock Exchange. AIM is more flexible. You can do as many acquisitions as you like. Frankfurt is more flexible still in that you can just have shareholder approval, and as long as your shareholders approve with what you're doing, you've got a much wider remit of things that you can go ahead and do. Other things are around things like centralized reporting. Do you have a decentralized management structure or a centralized management structure? Singapore and London don't allow decentralized management structures. New York and Europe and most other countries actually do allow a decentralized management function. So it's really important to understand the rule books in each of the countries that you want to operate in, because again, the advisors will tend to just sell you what they've got rather than walk you through the differences. Now, every single stock exchange publishes its rules, and they're not that onerous, you know. So anything from sort of 30 to 70 pages is a typical exchange rule book. Have a read, understand what the rules are, and decide whether or not that's going to fit with the business model and the plan that you're planning to execute. The other thing is liquidity. How many shares are traded on that exchange on a daily, weekly, monthly basis? Do the companies that list there get good liquidity, i.e. people buying and selling the shares regularly and easily? Some exchanges you'll see loads of companies that just sit there and never trade. So you want a nice liquid exchange where lots of people are trading. And then of course valuation. Now the best way to look at valuations is to look at peers. So look at companies in the same sector as the one that you're planning to list, or with a similar business model to the one that you're looking to list, and just see what sort of valuations they're getting on a few different exchanges, because there can be really big differences. We talked about the banking one already, so it's well worth just checking whether or not your peers are being sort of fairly valued in the exchanges that you're looking at. And then the other one, I kind of alluded to earlier, which is just there are low-cost places and there are high-cost places. You know, the cost of doing business generally in Australia, Singapore, UK, and US are much higher than the cost of doing business in, say, Frankfurt, Luxembourg, Milan, other other financial centers. So it is worth looking at, okay, if I pay a higher cost, do I get better liquidity and a better valuation? Because there may well be a trade-off that says, well, if I, okay, I'm going to pay a bit more, but I'm going to get a much better valuation, I'm going to get much better liquidity. But those things don't always follow. What seems to happen is that historically they had better valuation and better liquidity, and so the costs in that jurisdiction increased, and then they no longer have the liquidity and the valuation advantages, but they still have the high cost associated with it. So, so it is well worth checking. And particularly in those high-cost jurisdictions, it often makes sense if you're a very large company. But what we're talking about here is, micro-cap or even nano-cap businesses. These are very small companies that we're talking about listing initially, and then obviously they're growing through acquisition. Oh, excuse the dog barking. So so basically, you don't have to go with one of these high-cost jurisdictions in order to achieve the business model that you're trying to achieve. So how do you actually list? So the first thing is, do you need a prospectus? Now, if you're listing on an unregulated market and you're not raising money, then there's a very good chance you could get away with what's called an admission document. Now, an admission document is much simpler and much cheaper than producing a prospectus. A prospectus, now lots of people still call them prospectuses even though they're not prospectuses. A prospectus is a document that is approved by a regulator. So it's approved by the national regulator of where you're planning to issue the shares. Now, an admission document is more like a kind of business plan or an information memorandum about the business. So if you can avoid doing a prospectus and still achieve everything that you're trying to achieve, that's fantastic. However, having a prospectus does give you a lot of credibility, and it helps you raising money, and it helps you get more investors interested in your business. So, but speed of execution is very important. So what I often kind of recommend is using the kind of tiered system that exists in some exchanges. So in some exchanges, what you'll find is that they have sort of 2 or 3 levels of exchange. So this was described to me by somebody once as using a golfing analogy. Now, I don't play any golf, but they described it as you have a sort of driving range one, which is normally an unregulated segment of the exchange, where you get a little bit of institutional interest, you get some liquidity, and it really gives you a chance to, get a feel for being a public company. You go through the listing process, you're listed. It's relatively quick and easy to get listed onto one of these driving range type exchanges. And then what you can do is, once you've kind of done your first annual return, maybe even acquired a couple of companies, you could then go around moving up through their exchanges. So they normally have something in the middle, and then they have a main market, which has got all of the reporting requirements and all of the compliance requirements of a large company. So we very much did this with the company MBH Corporation that we listed. We actually listed it on an unregulated market. When we listed it, it was something called a SPAC, a Special Purpose Acquisition Company. This is effectively a company with no assets and no trading activity, and we just listed it on a stock exchange. We then acquired our first 2 acquisitions. We acquired an education business and a construction services company. And as soon as we did those 2 acquisitions, we then started the process of issuing a prospectus, getting that approved by the regulator, and then moving up to the next tier, the middle tier of the market. And that was quite a good process, because if we'd gone straight for the prospectus on day one, we probably would have spent a year or maybe even 2 years as a non-listed company, which means we would have lost a lot of time in being able to build a pipeline of potential acquisitions and having that credibility that we spoke about, in doing stuff. And actually, because we were a SPAC, we were able to complete those acquisitions using our public listed stock. So we were able to issue new shares to do those acquisitions. Of course, that's much harder when you're a private company. Of course, you can do these mergers, but what you're effectively doing then is a merger on the promise that you're going to go public. And that's quite a big ask, because for most people, going public is such a big idea and such an unseemingly impossible task, that there'll be a lot of doubt in their mind about whether or not you can pull that off. Well, obviously, if you're already public, you've kind of defeated the biggest obstacle that they had to deciding whether or not to come and join you. I apologize, I'm going to have to murder this dog, I think. The next one is timing. How long does this take? Well, the challenge is when you do a prospectus listing, you lose control of the timing aspect because effectively you're reliant on external parties and a regulator to decide on a lot of the aspects of the listing. So when you're reliant on those third-party external parties, it just kind of puts things beyond your control. If you do a non-prospectus listing where you're going for a junior market, it's much easier to design a timeline and to stick to it. And theoretically, there's nothing that should take longer than about 90 days from start to finish. They always take longer than that, but that's a theoretical timeline that you should be able to stick to. If you're doing a prospectus listing, you might be looking at 6 months just to get the prospectus approved and then a kind of listing process on top of that. So there's quite a bit of stuff that needs to be done. Where to start? Well, basically, you need to be audited is one of the kind of key aspects. So whether you're going to go regulated or unregulated, it's important that you have the company audited. And so understanding the audit process is probably quite a good starting point. So to reach out to the company's accountants and see if they will audit the company, and if they won't, would they recommend an auditor, or do you have one within your sphere of influence that you could bring in? Now, the process of getting audited is 90% systems and 10% the numbers that go into those systems. And I think a lot of people don't realize that. They just think it's someone checking your numbers. It's not really. It's someone checking the systems that drive the numbers so that they can be sure of the accuracy of the numbers that come out the other end. So so going through the process of being audited is a really healthy way of getting the business ready for an IPO. And then the next part is the research piece. So looking into which exchanges are going to give you that liquidity, that valuation, and allow you to execute your business model. And that's a relatively straightforward process of just downloading those rule books and having a read through and seeing which one you think is going to be the right one for you. Now, what you can do is you can partner up with somebody to do the listing. So traditionally, what companies would have done is they would have gone to a corporate finance company or an investment bank. The investment bank or corporate finance company then represents them in the listing. Like I say, they can only work with the exchange that they represent. So if they're an AIM nomad, they're going to recommend you go on AIM. And if they're a Frankfurt Stock Exchange sponsor, they're going to recommend the Frankfurt Stock Exchange. So we kind of have created a model whereby we get involved in your business. Now, we are not an investment bank, although if you look at all of the employees in my organization, Unity Group, we look like a boutique investment bank in terms of the skill set and types of people that we have. But we are not regulated as an investment bank. So we are a private equity company. So as a private equity company, we have to be shareholders in something that we take public. We can't give advice for money. So what we do is we take equity, we charge no fees, so it becomes a no money down transaction for the company that we work with, but we become equity partners with them as they go public. Now, that can be quite a mutually beneficial way to do things because the other party gets an experienced partner that's taken companies public before to take them public. They don't have to risk any cash, and they can be reasonably certain that they will go public, because when you go with an investment bank, well, as soon as you go public, they stop getting paid. All of the big retainers come in the time up to listing, and after that, they stop getting paid. So there's kind of like an incentive to drag things out a bit when you're charging a massive monthly retainer. With us, we're getting equity, so unless we go public, that equity really doesn't have any value. So we're very much aligned with the company. and very much motivated to get on with it and get listed, because any delays are costly to us as well. So not only do we provide a no money down route for companies to go public, we do it in a way that really does create a sort of partnership model between us and the companies that we work with. Of course, we're not a registered charity. This, we need to make sure there's enough upside in it for us as well. But of course, we can do that in a mutually beneficial way that works for everyone. So if you would like to, to reach out and have a conversation about this, by all means do, as long as you're audited and you have more than $500,000 of annual profits. Let's have a conversation and see what we can do. Now, an extra thing I just want to talk to you about very quickly is, once you're listed, we've got this really cool financial innovation that we came up with about a year ago. And since we came up with it, we've done about 40 million euros worth of acquisitions using this model. That's 40 million of value of companies in total that we've acquired using this model. And there's plenty more to go. I mean, we have a huge pipeline which have all been effectively pitched using this model. And basically, remember I said we created our own currency in terms of issuing the shares that are traded in the company. Well, another very common financial instrument that you'll see traded on stock exchanges is a bond. And a bond is basically a debt instrument. But the difference between a bond and borrowing money from a bank to do deals is, when you borrow money from the bank to do deals, it tends to be a sort of full recourse loan that the bank can call at any time. So typically there are covenants that you have to meet, and if you don't meet those, the bank can just change its mind about lending you the money and demand it all back straight away. As you may have heard that old expression, the bank gives you an umbrella but asks for it back when it rains. If you use bank loans, it puts you in a very precarious position, because the bank can basically pull the rug at any time and completely bankrupt your business. With a bond, you as the company are the issuer of your own debt. So effectively, whilst there are trustees and there's a lot of regulations around it, the bond is secured for a fixed period of time, and they won't change, can't change their mind and can't pull the rug out from under you. So for example, when we did this in MBH Corporation, we issued a 5-year bond with a 5% coupon. What a 5% coupon means is that we pay 5% every year on the value of the bond, and the 5 years is the term of the bond. So at the end of 5 years, the bondholder gets their capital back. Now, bonds have been used in mergers and acquisitions for a very, very long time. And in fact, in the 1960s, 70s, and 80s, there was a massive boom in using bonds for mergers and acquisitions. In fact, there were some negative uses of it, but there were also some really positive things. I mean, in fact, you could argue that most of the modern world was built on what are called high yield or junk bonds. When all of the internet companies wanted to roll out, billions of dollars worth of infrastructure all over the world, they did it by issuing high yield bonds. Interestingly, before that, the only people that really issued bonds were governments or very, very large companies like Ford or those sort of people. But what happened in the 60s and 70s is that small companies started issuing these bonds. They got the nickname junk bonds, which has stuck to this day. There's even an ETF called JNK for junk, which are bonds, despite the industry desperately trying to change the description to high yield bonds. But anyway, these tend to be bonds that are issued by corporate issuers and as a way of raising money. Now, what happened? I've looked at bonds many, many times as a way of doing deals. Because I'm into M&A, and I'm into buying companies without using bank debt and without using my own cash. And the challenge I always found with the bond market was that there are literally hundreds of thousands of different bonds that you can buy. I mean, Microsoft bonds, Apple bonds, and then all the way down the kind of business hierarchy to tin pot little companies that are issuing bonds. And so if you want someone to buy your bond instead of someone else's bond, you have to stand out. And unfortunately, the only ways that you can really stand out is by paying a much higher interest rate. And bear in mind, we are in an era of low interest rates at the moment. So if you have bonds at 9 or 10%, you're overpaying by an order of magnitude in order to get access to capital. And then the only other then the other thing is, okay, you have to have the high interest rate to attract investors in. You then have to have a high cost of distribution. So you have to pay the people who go out and sell your bonds more than anyone else to get them to sell your bonds instead of someone else's bonds. So what you end up with is, let's say you want 100 grand, which you'd never do, by the way, it would be tens of millions. But let's say you wanted 100 grand, you have to pay 10% interest over 5 years. Well, that's 50 grand of interest that you have to pay back over 5 years. So you're now paying 150 grand back for your 100 grand. And then you might have to pay as much as 20% into the distribution channel to get your bonds to the front of the queue. So now you're getting 80 grand and paying back 150. So you're almost kind of underwater by 50% on the day that you start. And I just couldn't see a way that you could ever possibly make that work. It just seemed ridiculous. So I'd always just dismissed it out of hand as not being viable. And you do often see a lot of small company bonds failing, and I believe that's probably the reason. They've overpaid for the money, and they're overpaying on the coupon, and it's simply not sustainable. When you look at your spreadsheet for a startup and you've got these huge margins, you think, yeah, we can pay back double, that's no problem. And then when reality kicks in, you can't. So I think they get themselves into a bit of a pickle. So we decided that that wasn't going to be a viable option for us. But then once we were listed and we were doing these acquisitions using our shares, I realized that actually if we issued bonds directly to the person who was selling their business, so we're not issuing them shares, we're issuing them bonds that are listed on the same stock exchange, so you can see the price every day and all that sort of stuff. If we issued them with bonds, we wouldn't have to compete with other bonds. We'd be competing with what they would do with the money. So if you think about it, when somebody sells their company and you give them $1 million, what do they do with that $1 million? Well, they might pay off their mortgage. They might go and buy a flashy car. They might buy a holiday home. Those kind of things. Well, all of those things are or they might put it in their bank account. So all of those things are sub 5%. If you pay off your mortgage, it's probably a couple of percent or 3% a year. A car loan might be the most expensive thing in that list, but it's still going to be like around 5 or 6%. If you put it on deposit in the bank, it's going to be less than 1%. So actually, if we issue a bond with a 5% coupon, which is much more affordable for the business, we're probably outperforming whatever it is the person was going to do with that money anyway. And then also, if we're issuing the bond directly to the business owner when they exit their business or when they're selling their business, then we also don't have any distribution cost. We don't have these spivvy salespeople trying to sell your bonds for you, so you don't get that haircut that you would normally have to pay for the bond distribution. So now you get the full value of the bond in equity in the company, and you just have the interest over the 5 years and then the capital repayment at the end of it. And so, if you think about it, you have this thing in M&A called vendor finance. And vendor finance is where the person selling you the business effectively agrees that you can pay them back over 5 years. And typically it doesn't have any interest, and typically they're just reliant on their own business as security for the repayment. With the extra bond, it's kind of like vendor finance on steroids, because they now have a group of companies that are on the hook. When you issue a bond, it's the senior debt in the company, so it's the only debt that the company owes. So they've now got whatever group that you're putting together is on the hook for repaying the bond. They can see it. When you do vendor finance, it's like it's just a legal agreement with some lawyers, and you don't really see anything. With a bond, it's delivered to your bank account. So when you log into your online banking and you've got $1 million in bonds, you see $1 million sitting in your bank account. There is an independent trustee fully regulated trustee that manages the collection of the interest payments and the distribution of the interest payments. So every 6 months you get a coupon. You don't have to chase people or say, where's my coupon, where's my money, where's my interest, or anything like that. Literally in your account appears the interest every 6 months, and at the end of 5 years the bond disappears and it's replaced by cash. So they have this kind of secure, comfortable feeling that this has been approved by an exchange and listed on a regulated stock exchange. It's got a regulated, it's got a proper prospectus that's been issued. It's got a regulated trustee that's managing the process for them. So, for example, we use US bank trustees as the trustee for the bond that we issued. It creates this, really good layer of comfort for people. Plus, there are some things they can do. They can sell the bonds back to the company. So the company that we listed, MBH, is regularly buying bonds back from bondholders at a little bit of a discount, because when it buys back at a discount, it gets to extinguish the debt and add the discount to the profit. So it's a great piece of financial engineering. Lots of people sell the bonds into their pension scheme. So if you have a personal pension or a corporate pension, that can buy the bonds off you. So that liberates the cash, and the pension just sits on the bond for the 5 years until it expires. So that's a great way of getting cash out. Or they can sell them into the secondary market. There are buyers that will buy the bonds. Like I say, you're back to incentivizing the distribution channel at that point. So you're likely to have a haircut, but nonetheless you can lay your hands on the cash a bit quicker by incentivizing that distribution channel. So this basically gives a fantastic currency that you can go out and produce. Now, once you have a listed company and you've done your first few acquisitions, so there's a bit of meat on the bone, issuing one of these extra bonds is a very straightforward and quick process. And again, a bit like we offer the no money down solution for listing your company, we can also offer you a no money down solution for listing your bond. You simply pay us in bonds, and we will do the whole extra bond listing for you. And by the way, under European law, anything less than 600 million euros is considered a small issue, and therefore it's a slightly easier compliance process to go through. So you can build yourself a hell of a war chest for acquisitions. So when we did our issue, we issued 50 million euros worth, and that was about the minimum the lawyer was happy to put his name to. He felt that was a very, very small issue to go ahead with. So if you'd like to do extra bonds after you've listed your company, we can also help you do that, and that gives you another currency that you can go out and acquire companies with. So I hope you like that. It's a really great little win-win. So where to go from here? I hope you've enjoyed this little mini-series, and I hope it's opened your eyes to some ideas that perhaps you hadn't thought about before. If you would just like to know about buying and selling companies, do the 21-day email course that I recommended at the beginning of this. It's completely free. There's no obligation to do anything else after that. I think you'll find it really interesting. It's a real eye-opener to a different area of entrepreneurship that you perhaps haven't thought about. We've got some great books that you can read. So if you just go on to Amazon, you can order Go Do Deals, which is my book around how to source, acquire, and sell companies. Entrepreneurial Investing by Callum Lang, which is all about how to use these capital markets type solutions for businesses. Agglomerate, which is our roll-up structure that we have trademarked. And Democratizing Wealth is my book that's coming out soon. So you can pre-order a copy of that if you reach out to us. And then the other thing to look at is Harbor Club. You can go to harborclubevents.com, and this is a global community that we have of people that are doing deals. We teach you everything from how to source companies, buy companies, all the IPO stuff, extra bond stuff. There's tons of user-generated content from our members who are actively running around doing deals. So when we do deals, we share the knowledge with the community. We have our own app, which is very active. We have really high engagement rates within the app and lots of people doing stuff. So if you would like to find out more about that, like I say, go to harborclubevents.com and register with us there, and we'll reach out and tell you about how you can become a member of that community. But I hope you've enjoyed this, and if you do want anything, do stay in touch. We publish lots and lots of free content because we want to educate entrepreneurs on how to do business differently. I know everybody talks about working on your business and not in your business, but very few people share practical, actionable ways that you can go out and do this. And we really spend a lot of time doing that. So do follow us on social media. Do keep up with everything else. And I wish you the very best of luck out there. It's a fantastic time to be alive. It's a fantastic time to be doing deals. There are loads of opportunities out there. If you just get your head out of the weeds and get out of the day-to-day grind of running the business, there's some fantastic things that you can achieve. So do keep in touch. Thank you very much for watching.